Sometimes the markets will look pretty much the same from one month to the next, or even 1 year to the next, almost boring. And then there are weeks like last week. A week ago, we had the illusion that the government was in control of interest rates, particularly the Fed. Why, after all, they'd been cutting the interest rate on multiple occasions last year, and everybody in Wall Street was saying, why, we've got more interest rate cuts coming from the Fed, all is good with interest rates. Well, that was last week. It was an illusion. And like I talk in the book, one of the keys to my efforts to make money is by being aware of illusions and how to work with them. What happened in the last week? Well, as it turns out, President Trump, in his varying tariff policy, shook up the confidence of a lot of people in Wall Street, including around the world. Could we really trust what the United States is doing in financial issues such as tariffs? Now, previously, under the Biden administration, it was more like sanctions against Russia. This time, with Trump, it was a new factor. Can we trust the United States in the financial area? It most affected the bond market. And I've mentioned in my newsletter a number of times that all of the debt that the United States has and its ignoring pretty much what gold was doing have caused an illusion. The United States, even despite the debt that I hear about, blah, 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 we're able to get out of it. Not this week. Because as a result of the tariffs, we had a major move down in the bond market. Interest rates are going up. My feeling is that the ability of, whether it's the Fed, whether it's the president, whether it's Congress, anyone, I don't think have the ability to prevent a further major potential decline in the bond market, a major rise in interest rates. And the reason for that primarily is what's going on every week, multiple times, by the Treasury. The Treasury has to raise over $100 billion every week. And how does it encourage people to become buyers? There's only one way. And that is, if they need a higher interest rate, you got to pay it. What's particularly concerning regarding interest rates is the number 5%. When interest rates started going up under the Biden administration, they were very, very low. Interest rates were 1 or 2% or even lower, and they moved up to almost 5%, pretty much across the board, whether it's short-term or long-term. And then, a couple of years ago, we got into a situation where interest rates started to go back down. My memory is that if you take, for example, the 10-year Treasury note, which got to an interest rate of just under 5%, went from like that all the way down to like 3.5%, a big drop, right? And so, again, the illusion was, okay, the government's in control. They're talking about, the Fed is talking about, well, we are sure we can get inflation down to no more than 2%, another illusion, in my opinion. And this was widely believed and pitched by the media until last September. In September of 2024, something very different happened. The Fed cut their interest rate, the Fed funds rate, I think from like 5 to 4.75. What did the bond market do? Did it go down? No. Did interest rates go down in the bonds? No. Interest rates went up, the opposite of what the Fed was doing. So that my memory is that if you take the 10-year bond, which was at, as I said, 3.5, 3.6% interest rate in September, roared all the way up to, again, 4.6, 4.7% by December. To those of us who've looked at this, I'm particularly acknowledge my debt to Alistair MacLeod, who has focused on these things, that this is saying that the reasons why interest rates will go up are now becoming more powerful than the reasons that the Fed is talking about of why they can push interest rates down. Since December, we had a little bit of a lowering in interest rates, largely because of the enthusiasm, in my opinion, of the election of Trump and of doing a better job running the country. And so we went from the 4.7 to 4.8 down to like the low fours, I believe, until last week when this tariff situation caused a lot of uncertainty. So now those interest rates are moving up dramatically. And if you look at the chart of the bond market or the stock market last week, you both see bearish drops in both, particularly in terms of interest rates, that interest rates are going higher. As I say, the amount of debt and the crucial necessity for the Treasury to pay whatever interest rates they have to on the $100 billion they've got to find. Most of that, of course, is not new debt. Some of it is, but most of it is maturing treasuries, whether it's short-term or long-term, are maturing. And of course, the owners of those treasuries get their money back. And the hope by the Treasury is that they'll turn around with the cash that they get and put it back into treasury bonds. Well, the concerns that are now apparent in the way even the American Wall Street types like Jim Cramer, who's always optimistic or always trying to do what he hears the Wall Street types want him to do, which is almost invariably keep the stock market from collapsing and also keep the bond market from collapsing. Their ability to do that kind of stuff is weakened. So therefore, the ability of the media to support either the stock market or the bond market is weakened by the politics of what the Democrats want to do. So you put it all together, and as I say in my newsletter often and on, that when it looks at interest rates, for goodness sakes, expect them to go up. And for those of you who are not as speculative as me, the biggest thing to think about is if you've got money in fixed income, in bonds, or in long-term mortgages, get out of all of those that have a maturity of more than, say, a couple years. And the reason for that is that if you have, let's say you have a treasury bond that is for 30 years, and you think of interest rates going up from where they are now to what they were at during the last major inflation issue of the 1970s and 80s, you had the 30-year didn't stop going up from 4% to 5% or 6%. It went up to 15%. And that would cause, if you had bonds that were, say, selling at 100, when it goes up to 15%, you might lose 40-50% of your money just in the bond market. So take my advice. Get out of all of the long-term fixed income. If you're looking for yield, I'm a big fan for the average person of money market funds. Or if you want to get the newsletter, you might take a look at what I have to say about high-yielding possibilities with a firm about which I am very supportive called Annaly. If you look at the most recent newsletter, you'll find their forward dividend rate 16%. Think about it.